Okay, so I can see the numbers ticking up. Once again, good afternoon. My name is Katie Kent, and I'm a member of Enterprise Ireland's Trade and Tariff Response Team. And I'm pleased to welcome you to the fourth in our webinar series around the changing global trade environment. We've heard to date from experts on tariff changes, pricing, and managing strategies for managing tariff changes. And you'll find more resources on this on our website. This week, we're going to look around the corner a bit and explore what might come next from a US perspective, and also how the EU is looking at responding, whether that's related to tariff, taxes, or other measures. And China's role is also going to be discussed. So the International Policy Uncertainty Index, which is a thing, has reached a historic peak, and that was in April 2025 after Trump's Rose Garden announcements. And it's still, I suppose, measuring uncertainty at a level that's far above where it was during Brexit, COVID, and even the financial crisis. So we're aware that this is really challenging for our clients. And while nothing is certain, our hope is that today's webinar will help you look and identify at potential risks, opportunities, and changes coming, and help you plan for that. And Enterprise Ireland is there to help you. We focus on providing information and resources through webinars, through our funding and guidance to access advisory supports. Our first piece of advice to you as clients is always to engage with your client advisors around supports, and also to avail of our overseas network when you're looking at trade positioning and your diversification options. Our website, and I'll post the link to the Trade and Tariff site, will point you to some resources where you'll find FAQs, details of our consulting supports and market diversification supports. And we can also signpost you to experts like the ones we're going to hear from today, in the areas of trade and customs, supply chain management, financial planning, and a lot more. For trade-specific queries, you can send them through to our email address, which is exporttariffs@enterpriseireland.com. So without further ado, then, I'm delighted to present our speakers today from Flint Global. So Flint is an advisory firm with a focus on providing companies and investors with insights into policy, politics, regulation, and competition. And our speakers today are really well qualified to speak to you about the changing environment. First up, we have Sam Lowe. Sam is a partner with Flint, and he manages Flint's trade and market access practice. He advises clients on global trade policy, supply chain issues, customs, and economic security. And he's regularly quoted in the FT, in The Economist, on trade issues. And Sam is joined by his colleague, George Riddell. George is a senior advisor at Flint, and he has a previous background as a trade strategy director with a Big Four firm, where he advised companies on supply chain risk, trade compliance, and regulatory issues. So I'll hand over to Sam now, but before I do, just to let you know, we'll record this presentation, but we'll stop the recording for the Q&As. A number of you have submitted questions as well, so we'll come to those at the end of the session, and please do submit further questions into the Q&A box or the chat as you see fit. All right, thanks, Sam.
Thank you very much, Katie, for the kind introduction. I thought I'd start off by just putting the current situation into context, given that it's sometimes tempting to believe that the most recent Trump interventions and the tariffs being both threatened and imposed have come out of nowhere, whereas we actually view this as the continuation and escalation of a trend that's been present for a while, insofar as economic security, which is this concept that sort of stretches governments' definition of national security to the economic space and creates a view that it is in a country's interest to produce certain products domestically, or at least to reduce your reliance on those products from often China, but not exclusively China. This has been a theme for a while. We've seen it in the context of both the previous Trump administration, but then the Biden administration that followed. We've seen it in the context of European policy, where the European Commission has been, for example, more aggressively imposing tariffs on, for example, electric vehicles coming from China, but also in other sectors such as steel, aluminium, plastics, and elsewhere, but also in terms of the industrial policies being pursued. Under the Biden administration, we had the Inflation Reduction Act, which was designed to incentivize the production of green technologies within the US and discriminated against products being produced elsewhere. In the EU, you have more recent legislation such as the Net Zero Industry Act, which creates new resilience criteria, again, to incentivize the production of certain key technologies locally, but also discussions around funding pots and conditionality. So while the Trump intervention has been a shock, and there's no doubt about that, it's not necessarily come out of nowhere. I think what we've seen with Trump is that's different from the administration that came before it, the Biden administration, is that he is now attempting to use tariffs to force companies to produce and invest in the US rather than subsidies and other incentives. It's a sort of very blunt instrument, but it's one that we know he likes and that he used quite extensively during his first administration. I think it's also important to mention just national security more purely in this context, where the other major event of recent years, not including COVID, was of course Russia's invasion of Ukraine. And since there, from the export perspective, there's been a much greater scrutiny on what is being sold and who it is being sold to. And this has obviously led to a clampdown on the sale of certain products, and not all of those products are sort of obviously national security related. Some of them are being blocked or are being challenged on the basis they're being sold to actors that are deemed to have some link to either militaries or to actions and events taking place in Ukraine. So that's the context. And I think that's important, because we shouldn't assume that Trump is an anomaly and that were he to go away in future, that we'd return to normality, that the US would return to being an open market that is very easy to interact with. And we'll come on to this more, but from our perspective, while we don't necessarily expect all of the Trump tariffs to remain in place at the levels they are now, we do expect tariff levels at the end of this administration to be higher than they were at the beginning, and for those tariffs in many instances to persist into the future. I thought, given the context, it is useful to just provide a snapshot of exactly where we are now, because of course it's quite easy to get confused by all of the different reporting of the different threats and the different measures that have been imposed. And I should also say up front, because this could come up, one of the hardest questions any of us can be asked at the moment is, what is the specific tariff on product X applied by the US? That should be an easy question. It very rarely is at the moment, given all of the different measures that are in play. But if we're looking at the tariffs applied to the EU, in terms of the new tariffs, there's currently a 10% so-called reciprocal tariff on EU exports to the US. At the end of the 90-day pause, as it's been called, so that's the 7th of July, this could be doubled to 20%. Alongside this, you have the product-specific tariffs that the Trump administration has imposed on steel and aluminium, both 25%, and also automotives at 25%. There have been threats of tariffs in other sectors, including pharmaceuticals. We do not know yet exactly what that will look like or what the rate would be, but we keep being told it is coming. In terms of the driver of these tariffs, I mean, there's no single driver at any one time, but I think the one that's most important to bear in mind from a business perspective is that Trump has consistently said he wants companies to make more things in the US if they are selling those products to US consumers. And while there are other drivers, for example, the desire to contain Chinese dominance in certain areas, and also we should remember the desire to raise revenue from these tariffs to offset proposed tax cuts, that does point to their persistence. He's been saying this for years. I don't think he's necessarily going to change his mind. In terms of the EU response to these tariffs, so far it has been fairly measured. It has produced 3 packages of retaliation. The first 2 were a legacy of the first Trump administration and largely match the EU's response to Trump 1.0 steel and aluminium tariffs. This covers products such as Harley-Davidson's and Levi's, and in the first instance, first time round with bourbon, bourbon's actually been taken off the list this time, but it has been pushed into tariff list 3, which the EU signed off about a week ago. In terms of where we see this going, at the moment, the EU has been prioritizing negotiations with the US. These have not been going very well. We've obviously seen the US conclude negotiations in part with the UK and also with China. The EU has been really struggling to get traction. In the last week or so, this has improved slightly, and the EU and the US are now actively talking to each other. However, I would say that from an EU perspective, it is still not clear what the US actually wants, and the US says the same in the other direction. So we're not necessarily close to a deal here. And if we're being frank, the UK deal only emerged because the president decided one night that he wanted it, and the next day they managed to announce something. And there is a suspicion that that might be how most deals come about. So they'll be quite difficult to predict in advance. One thing I would say is that if the 20% tariff is reimposed on the EU, and we'll have to see what the US does here, I would expect the EU to retaliate with its own tariffs on US products. I don't necessarily think it would go straight to list 3. So this is the £100 billion worth of retaliation. You can see some of the products covered on the slide I've just flashed up, but I think it will go for list 1 and 2, which is the slightly lower 20 billion in total of tariffs, which would then give it some room to go further if Trump escalates even more so. From a escalation perspective, there is always a risk that if the EU starts imposing tariffs on the US will retaliate and escalate further. Last time, at the beginning of all of this, when the EU first mentioned it was considering retaliation, I'm sure you saw the Trump social media posts threatening tariffs on EU champagne. So it can get quite specific and quite nasty quite quickly. In terms of where I expect this to go, I think, this is slightly a fool's game putting percentages on anything, but I think the main point to draw from the scenarios that I've flashed up on screen is that even if there is a deal between the EU and the US in Q2, and I should say we do think that that is still a reasonably high possibility. We've got that at 55%. That does not mean a return to the status quo. It does not mean a return to pre-Trump tariff levels. When we talk about a deal, we are talking about limited relief in certain specific areas. To use the recent UK agreement as an example of this, the UK managed to achieve tariff relief on automotives for 100,000 units every year, and it was not a return to the 2.5% that the US imposed beforehand. It was a reduction from the 25% to 10%. We still do not know the details of this quota, how it will be allocated. We do not know the rules of origin provisions which will be imposed on the exports that are covered by the quota. Any tariff relief in this context, we should assume, will be conditional on meeting certain origin provisions, or will be in the context of a quota, and could also place further obligations on companies and countries in respect to China, insofar as the UK arrangement refers repeatedly to commitments on the UK side to impose certain supply chain obligations on companies. And we've also seen in Trump deals in the past that there have been conditions related even to the audit of specific companies that are linked, that have Chinese ownership or Chinese links. So a deal in and of itself is still messy. It's not necessarily the end of the story. There will still be lots to work through. I should also say that, when we talk about these tariff rates, because I know this is a question that gets asked a lot, they're often on top of additional duties. So for example, we talk about 10%. This is 10% on top of whatever the usual US tariff was originally. So if the original most favored nation, as it's referred to, US tariff was 2.5%, and you then have 10% on top of that, you then have a 12.5% tariff. In terms of how the different tariff measures all interact, some of them stack on top of each other and some of them don't. So when I'm talking about, for example, existing US trade defense tariffs, by which I mean anti-dumping tariffs or anti-subsidy tariffs. So these are tariffs designed to either stop companies pricing unfairly low in the US market, or because there's views that companies unfairly benefiting from state subsidies. Those sometimes stack on top of some of the tariffs that have been imposed. It's massively complicated. I refer back to my statement at the beginning. I think for every individual product, you actually have to work it through to make an assessment as to what the tariff is and what it will be. And the point here is that whilst I think they could change over time, I don't necessarily think they're going to go away. We put comprehensive free trade agreement. There's a 5% possibility. Some people would say that's too high. I'm going to hand over to George here.
Fantastic. So following on from what Sam said, sort of going to unpack a couple of the more recent developments, what they mean, what we're seeing out there in the market in terms of how businesses are interacting, and changing their operations in response to these policy measures. I think one thing to add on top of what Sam has said, and really sort of around that stacking point, because it is a great illustration of the environment that we're currently finding ourselves in, is the delay and the lag between something being announced policy-wise, whether that's via social media, so True Social with the president normally late at night, our time, so it's a nice thing to wake up to in the morning, so worried about what's happened. And then the actual executive orders and customs guidance being released. Sometimes we're seeing a delay of up to a month between those two things happening. And often there's quite a lot that's different in between what's been announced and then the actual detailed policy documents. A great example of that was on Liberation Day, when all the countries had their different tariff rates associated with them up on those big boards. What was actually published a couple of days later in the executive orders, the tariff rates were different from what had been announced a couple of days previously. So I think always checking not just the announcement, but what the actual detailed guidance says is an incredibly important part of the business planning, because there just isn't that consistency at the moment. And that's something I think we can expect to continue. In terms of the impact on Irish exports to the US, I think you can see on the left there, and we pulled this data from Eurostat, the European Statistics Agency, around Irish exports. There is, of those exports that aren't going to the EU, there is very much an over-indexed amount when compared to the other EU member states in terms of Ireland's exposure to the US. So it really is a material issue when it comes to navigating these new tariff frameworks. In terms of how the other thing to sort of look at, and Sam, maybe if we just move to the next slide, it is around sort of where those big impacts could potentially come from. I think, amid the arising protectionism that we're seeing in the US and the reshoring of manufacturing, there is a potential undercutting of the use of Ireland as a low corporate tax headquarter. And that is something that the European Commission has identified as a potential risk moving forward. Potentially, also with that one big beautiful bill and the tax reforms that the US are currently undertaking. So understanding those dynamics and adapting, I think, is absolutely a crucial element that we've been advising a lot of companies on. When it comes to that big beautiful tax bill that currently is going through the US Congress, I know we've been talking a lot about the protectionism side with the tariffs. If that bill makes it through the necessary votes, and that is very much a question mark at the moment, there are quite a few tax breaks, in particular around research and development, setting up new manufacturing headquarters in the US and operations. The businesses will be wanting to look at as part of that overall market access assessment of the US. Yes, it's getting a lot difficult in terms of the trade flows with the tariffs, but on the other side, there may be some tax advantages as that piece of legislation is implemented over the coming period. So definitely something to balance up. When it comes to the triggering of second order effects, so that last bullet point on the screen there, I think that really picking up on what Sam was saying around China is that if we're going to see quite a lot of back and forth around the use of Chinese intermediate products in trade flows going forward, particularly around the US, where those components, particularly from a rules of origin perspective, are going to come under increased scrutiny because ultimately determining whether or not something's an Irish product, a European product, or a Chinese product, depending on that origin, is going to determine what tariff level it faces. And this is something that I think anyone who's worked with the US customs authorities, some of the decisions that are made around non-preferential origin and the determinations of where a product actually comes from for customs purposes isn't entirely logical in all instances and can lead to some perverse outcomes. So staying on top of that origin management, the necessary calculations, and also evidencing that those components are coming from where you as a business are saying they're coming from is going to be increasingly important. And that is actually something we've seen a massive uptick on in the last couple of weeks, is how many audits and post-clearance investigations that CBP is currently undertaking with quite significant fines associated with that. One of the interesting things that we've seen is not only has CBP been exempted from some of the wider US government department cuts that Elon Musk has been leading on with the Doge initiative. CBP has been exempted from that. They've been given even more resources to hire investigators and post-clearance auditors. So definitely something that they're looking to take an increased action on moving forward. Coming to the EU, there are a number of potential, as Sam said, retaliatory tariffs that could be put in place on on American products coming into the EU. There are other measures also being considered. I would say alongside the response to the retaliatory tariffs is also around export restrictions of certain products from the EU to the US in retaliation for the tariffs. Most notably for the food and drink sector. That includes several substances around odoriferous inputs. So definitely something to watch. It's not just American products coming into the EU that could attract restrictions, but also potentially sensitive products from the EU to the US as well. There's also the risk if we do end up in a retaliatory spiral, the new European defense legislation known as the anti-coercion instrument could be triggered, not necessarily in response to these tariffs. We've seen the European Commission be quite cautious around how it talks about using the anti-coercion instrument, but it is something that they're keeping in their back pocket. And there, the potential responses move much beyond just tariffs and trading goods to intellectual property, services trade, and other elements as well of the bilateral trade between the EU and the US. So definitely something to watch as well in terms of how that potential retaliation takes place, if indeed it does. Coming on to what this actually means for businesses, I think, as I've been saying, this focus on trade compliance is no longer something that you can leave to one person within the business and assume that everything's going to be okay. The cash flow implications of the increased tariffs, the potential fines from CBP, and also the increased logistics challenges as containers and ships end up not necessarily in the right part of the world, means that we are definitely seeing this become a C-suite issue, a board level issue, with the required resources needing to be made available, so that one person who previously might have been dealing with the issue and managing the trade compliance, actually that job has become a lot harder. It's become a lot more volatile. So we're seeing the businesses responding to that, particularly for some key sectors like pharmaceuticals that haven't had to deal with tariffs for a very long time. For the EU and the US, those products have been zero rated since the WTO Pharmaceuticals Agreement that was agreed back in 1995. So the whole setup of a lot of pharmaceutical businesses trading between the US and the EU haven't had to think about customs and tariffs for quite a long time, which has implications for things like origin. And coming back to that point I was making around CBP, with taking quite a liberal interpretation of where pharmaceuticals originate from based on some of the active ingredients that are contained within them, not necessarily where the different component parts have been mixed or processed. So things like that, definitely around origin, becomes very important for the pharmaceutical sector, but also more broadly. Also in the case of valuation, often for that industry, because they haven't had to think about tariffs as much as potentially other industries over the past 3 decades, a lot of the customs valuation has been done on the basis of transfer pricing and how that interaction works from an entity to entity perspective in moving products from the EU to the US. Obviously, if you've got a very high customs valuation, that is going to impact the liability when it comes to the tariff exposure. So that quite complex interaction between what's the customs value and how you pricing it from a transfer pricing perspective does become incredibly important moving forward, and also requiring quite a detailed discussion between tax teams within the business and those dealing with the customs issues, because you can't be taking decisions around these things independently, as perhaps may have been the case prior to these new tariffs coming in the US. Definitely seeing some quite extensive reviews of supply chains and partner networks, not only to understand what trade risks there are, so tariffs, origin, things that we've been talking about through the course of this session, but also how to potentially put in place mitigation options and optimization moving forward. So how do you actually, in an increasingly volatile world where the US president could wake up and on any given day and announce tariffs on XYZ countries, and indeed countries that were previously considered to be safe or at least aligned with US trade policy, like Canada, like Mexico, that no longer being the case. So how do you build resilience into those supply chains moving forward, particularly around avoiding single sources of critical supplies, moving towards potentially regionalized networks as well, depending on your operations, how do you think about that, and also diversification away from the US where that's feasible, in order to offset some of those risks and dependencies within the supply chain. I've spoken a lot about reviewing necessary customs arrangements, so not necessarily going to continue to harp on that point. The one thing that I would say, in addition to what I've been talking about previously, is anytime a supply chain adjustment is needed, the corresponding changes need to feed through into the customs arrangements as well. So this is something that's going to need to be under constant review. It's not something that you can say, oh, we've dealt with the customs issues around origin valuation, but then make some big changes to your supply chain. That's all going to need to be a continuous reviewed and also audited process within the business to make sure not falling foul of any of the new rules coming through. This is all having an impact on cash flow, not just from the direct cost implications of the increased tariffs, but also potentially around the increased cost of transportation. We have been seeing the cost of shipping tick upwards over the past couple of months. We're also seeing longer lead times when it comes to contract settlement, as businesses are experiencing these border delays, increased cost at the border. There is a knock-on impact that we're seeing in terms of settling of contractual arrangements, and sort of how that could potentially impact the cash flow of your business. Definitely something to be talking about. And also, if you're impacted, speaking with your suppliers, speaking with your customers, in order so that there is that flow of information, is actually quite crucial. All this leads to a real message that in an increasingly volatile world, something, this isn't going away. As Sam said, we have reset to a new normal of reducing over reliance on single suppliers, products, or potentially vulnerable regions. Is definitely a corporate strategy that we are seeing integrated at all levels of business, and just going to be how I think we move forward. That does come with increased costs, pressures, but being able to sleep at night, being able to, that if you do experience a particular shock or disruption, it's going to be more manageable with these potential mitigation strategies. Sam, I think at this point I'm
handing
due
back to
to
me,
pass back
and I'm
to you.
handing to Katie for Q&A.
And thanks a million, guys. I'm going to stop the recording now.